Hello and good morning, everyone. Today is our next session for finance for managers. Today, this is learning outcomes today too, and our aims and objectives are introduction to investment appraisals, discussion of net present value, ARR, PBP, and IRR. Explanation of break-even point objectives. Learner will be able to discuss the NPV, ARR, PBP, and IRR. So describe what is meant investment appraisal, define what is meant break-even point. What do we know about the investment appraisal? So let's define what we mean by investment appraisal. Investment appraisal is a process used by businesses to compare the expected future income from an investment with the expenditure required to make that investment. So in simple terms, it helps us determine whether an investment is financially viable or not. Can you see my screen and anybody can hear my voice if anyone is there? Okay. Can you see my screen properly? If there is any issue, please just let me know. So investment appraisal. So now we will discuss the concept of investment appraisal and its significance in evaluating the potential benefit and cost of an investment. So investment appraisal is a business concept that involves comparing the expected future income from an investment with the expenditure required to make that investment. So this analysis helps decision makers determine whether the investment is financially viable and likely to generate a positive return. In non-profit organizations where the primary goal is not to earn a financial return, the concept of investment appraisal may not be directly applicable. But even in such organizations, investment appraisal techniques can still be useful for comparing different proposals and ensuring that money is spent wisely to achieve the best value. Investment appraisal methods. There are, investment appraisal methods are techniques used to assess the financial viability of potential investment. So there are different kind of investment appraisal methods, such as payback period, discounted payback, net present value, internal rate of return or IRR, sensitivity analysis, BEA, break-even analysis, accounting rate for return. So what is time value of money? So anybody can tell me what is time value of money or any issue, any idea? Okay. What is difference between £1 now and £1 in a year's time? So understand the concept of the time value of money. Money has a different value over time due to various factors like interest, cost, inflation, and other rates. So for example, £1 today is worth more than £1 a year from now because of inflation and the opportunity cost of not investing the money. So to calculate the future value of money, we use the formula like future value is equal to present value multiplied by £1, after £1 plus interest rate. Okay. So that is the formula. So for example, here, so for example, the annual interest rate is 10%. I lend you £1 now and will back after 1 year. How much worth of the £1 in a year's time? So formula works like this. As I said, future value of money, then 1 plus interest rate present value, 1 plus 10% of is equal to £1, 10 pence, or is equal to, so 10% is called cost of capital, is called the discount factor. Discount factor and cost of capital. So the discount factor represented by is used to calculate the present value of future cash flows. The cost of capital interest rate is the rate used to discount future cash flows to their present value. Any questions so far? Okay, so now we will discuss payback period. The payback period is the amount of time taken for the net cash flow resulting from an investment to match is equal to the initial cost of the investment. F9 Kaplan book is a reference of the book, which is F9 Foundation 9 Kaplan book ACCA. So the payback period represents the time required for the net cash flow from an investment to equal the initial cost of the investment in order to words. So it tells us how long it takes to recoup the money initially invested. The formula for calculated the payback period is very straightforward. Divide the initial investment by the annual cash flow. Initial investment divided by annual cash flow. So this formula is only applicable if equal cash flows. So what is the advantages and disadvantages of payback method? So it's a very simple to use, assists with cash flow, effective when technology is fast changing. So disadvantages, obviously there are some disadvantages of, so disadvantages: ignores flow of cash over the lifetime of the project, ignore total profitability. So ignore flows of cash over the lifetime. One limitation to the payback method is that it overlooks the cash flows generated beyond the payback period. It focuses solely on recovering the initial investment and does not consider the profitability of the investment over its entire lifespan. Neglecting total profitability. Here, another drawback of the payback method is its failure to account for the total profitability of an investment. So while it helps determine when the investment will break even, it does not provide insights into the long-term profitability. So payback examples here, you are considering which of two machines your organization should purchase. Both machines cost £60,000. Machine A will produce £20,000 of cash inflow for 4 years and then be ready for the scrap heap. So while machine B will produce £15,000 a year for 8 years before it needs to be replaced. So while machine would you buy if we're using the payback methods? So step 1, let's look at the cumulative cash flow at the end of year 3, which is £400. Okay. Example A here. Okay. So which is for we need to recover £10,000 with initial investment for this cumulative cash flow. And step 2, in the year, which of these machines do you think will actually be better investments? So in step 2, in machine 2, calculate the payback period. We divide the remaining amount to be recovered, £600 by the cash flow in 4 years, which is £500. This gives us 6,000 divided £600 divided by £500 is equal to 1.2. 2. Here. Okay. So look and cumulative cash flow in end of the year 3, 400 left to meet initial investment, and year 4, our cash flow is 500. So our payback period should be 3 years and some months. So 400 divided by 500 is equal to 0.8 years. So 0.8 multiplied by 12 is equal to 10. So now payback is 3 years and 10 months. Discounted cash flow or net present value. So now we will discuss what is NPV and how it's calculated. Net present value measures the change in shareholder wealth resulting from accepting an investment project. It is calculated by subtracting the present value of cash outflow from the present value of cash inflow. So if the resulting net present value is positive, it indicates that the project cash inflows will generate a return higher than the cost of capital. In this case, if the cost of capital matches the organization's target rate of return, the project is considered viable. So on the other hand, a negative net present value suggests that the project cash inflow will yield a return lower than the cost of capital, indicating that the project should be avoided. If the net present value is 0, the project is expected to provide a return equal to the cost of capital, but it may still carry inherent risks that make it less attractive. Net present value pros and cons. Again, disadvantages and advantages. So advantages: direct link to shareholders' wealth. Consider time value of money, uses all cash flows, absolute measures return. So cons are difficult to explain, require a cost of capital, rather complex. So I mean, that's, that require a cost of capital. Calculation involves complex financial concepts such as discounting and present value. So requires cost of capital means that calculating net present value requires knowledge of the organization's cost of capital. So then complexity, NPV calculations can be complex, especially for projects with multiple cash flows occurring at different time of periods. Any questions so far? Anybody can have any question? Can you see my screen? Okay, I think so. No one is there. So next one is example of net present value. There are some examples only: net cash flow, PV factors, present value. Okay. Then example of net present values calculation. So it's a simple illustration how net present value is calculated. So suppose we have a project with the falling cash flows. So year 0, initial investment of £120,000. So year 2 is 50,000, 3, year 1 is 50,000, then 60,000, 80,000, and then 40,000 for year 4. To calculate the net present value, we need to discount each cash flow to its present value using a discount factor, assuming a discount rate of 10%. So the discount factors of each year would be year 1 is 0.926, year 2 is 0.857, okay, and then 0.754, then 0.735. So net present value is 7,640. Here is again activity: calculate payback period net present values using cheat shot or So to find the payback period, we start by subtracting each year's cash flow from the cumulative total cash flow from the cumulative total until it becomes positive. So let's go through the quick calculations step by step. So cumulative zero is 1900 pound year one, 1600 pound, 1900 plus 300 pound will be 1600, then plus 5 would be minus is equal to 1100 pound. Then here will be year 3 will be plus again and would be 1500 pound. Year 4 cumulative total will be 500 plus 800 is equal to 300 pound. So to cumulative total becomes positive in year 4, indicating that the investment is recovering in that year. So therefore, the payback period for this project is 4 years. So if you calculate the net present value is 9100 divided by 1 plus 0.10, 1900 pound. Year 2 will be 272.73 year year 1, and year 2 will be if you calculate 500 divided by 1 plus 0.2 is equal to 413. Then year 3 calculation will be 600, again same formula, net present value 1 plus 10 0.10 divided by 3 is equal to 496. Yeah, so again year 4 present value will be 800 pound divided by 1 plus 0.10, and then year 5 present value will be 500 pound divided by 1 plus 0.10 is equal to multiply by 5 is equal to 380.16. So to find the net present values, we sum up the present value of cash flow. So net present value is equal to 1900 plus 272 plus 413 plus 496 plus 611, and then that will calculate all the net present value will come up. So net present value of 7274 indicates that the project is expected to generate a positive returns above the required rate of return. So 10% in this case. So you can try to solve your own. So payback net present value applications method, both useful to make any investment decision, either going to buy a new machine, new building, investment decision, either going to buy a new machine, new building. So all big organization using project appraisal to measure cost benefit, help to measure which project is more valuable compared to other projects. And accounting rate of return, so sometimes called the return on capital employed. So accounting rate of return is the ratio of average profits to initial capital employed expressed as a percentage. It helps determine the profitability of a project over its lifespan. Then here to calculate the ARR, all the 3 projects considered by BS Holdings, sum of all the years inflows and divide by the number of years to give average profit, then divide by initial capital invested and multiply by 100. So here is the whole calculation for the project, and over here. So here is 5%, and then Bristol is 5%, then 8% for Carlisle. So based on the ARR value, Carlisle is the most attractive project with the annual, rate of return. So it offers the highest average profit relative to initial capital invested. So here to payback period, calculate the exact payback period for the following projects and determine which project should be pursued. So year period A, period project B. So if you look at here, that calculation, year one is 10,000, project B 10,000, 35, then 600, then 3,500, then 4,000, 35, then 500, 35, 500, then 35, 0. So to calculate the payback period, we sum the cash flows until we reach or surpass the initial investment. For project A, the payback period is 3 years. So 10,000 plus 3,500, 3,500 plus 3,500. So project B, the payback period is 4 years. So 10,000 plus 6,000 plus 4,000 and plus 500. So based on the payback period, project A should be pursued as it has a shorter payback period than project B. So what the, again, a question, what the factors should we consider rather than the payback period? So factor to consider besides payback period, while the payback periods provides a useful metric, it is important to consider additional factors when evaluating investment projects. So some of these projects factors including risk, cash flow, project lifespan, and discounted cash flows. So here determine which projects from the three below should be pursued using the ARR and initial investment period. So accounting rate of return method measures the average annual profitability of an investment as a percentage of the of an investment, a percentage of the initial investment. So here he is calculating the ARR for the three projects, project A, B, and C. So project A is the 60%, AR is 70, B for a 7.5%, and project C will be 30%. So based on the ARR method, project A should be pursued as it has the highest rate of return. Here is a quiz. You can go online and check if you want to solve this one. So next one is definition of breakdown analysis. Anyone can tell me what is the break-even analysis? Any questions? Okay, so break-even analysis, or the break-even point, is the level of activity at which the total revenue earned is equal to the total costs incurred. So at this point, the company is not making any profit, but it is not incurring any loss either. So applications, break-even analysis can be used to determine a company's break-even point. Break-even point is a level of activity at which the total revenue is equal to the total costs. At this level, the company makes no profit. Assumption of break-even point analysis, relevant range, fixed cost, variable costs. So assumptions we make when conducting a break-even analysis, first we consider something called the relevant range. This is the range of activity over which the fixed costs remain constant in total and the variable cost per unit remains constant. So it is important that these assumptions holds true only within the relevant range. So similarly, the total revenue earned from sales will increase as the number of units sold increases. So revenue is the money a company earns from selling its products or services. When more units are sold, the total revenue goes up. Here the chart showing total cost, variable cost, fixed costs, sales units, and cost goes up. So total cost of revenue here. So this is between sales revenue and total cost. This shows profit. Calculation method break-even point. So break-even point, target profit, margin of safety, changes in components of break-even analysis. So calculation method, how we calculate the break-even point, it is key metric and break-even analysis. We can calculate the break-even point by dividing the total fixed cost by the contribution margin per unit. The contribution margin per unit is the difference between the selling price per unit and the variable costs per unit. Here it's showing something. Here is the formula. Here break-even point is equal to fixed cost divided by contribution per unit. Then sale revenue at break point is equal to break point multiplied by selling price. So there is alternative method. Formula is sale revenue at break even point, contribution required to break even divided by contribution to sales ratio. So contribution per unit divided by selling price per unit. So break even point in units is equal to sale revenue at break even point divided by selling price. So example, to see how these calculation work, suppose we have a selling price per unit is 12 pound and the variable cost per unit is $3. So fixed cost will be 45,000 pounds. So compute the break even point. Break even point is units fixed cost contribution per unit, so is equal to 45,000. Divided by 12 minus 3, so is equal to 5,000 units. Sales revenue at break point is equal to 12 multiplied by 5,000 is equal to $60,000. If we choose, or if we go to here different alternative methods. So alternative method contribute to sale into ratio $9 divided by $12 multiplied by 100 is equal to 75. So to calculate the sales revenue at the break-even point using the contribution to sale ratio, we divide the fixed cost by the contribution to sales ratio. So sales revenue at break-even point is equal to 45,000 pound divided by 75%, which is equal to $60,000. So break-even point in units is equal to $60,000 divided by 12 is equal to 5,000 units. So here is a target formula. No number of units at target profit, fixed cost plus target profit divided by contribution per units. So required sales revenue, fixed cost plus target profit divided by contribution on sale ratio. So here is example, selling per price per unit is equal to 12 per unit. So it has fixed cost amount is again $45,000. The variable cost per unit is $3 per unit, and the company aims to make a profit of $18,000. So we can use this information to calculate the break-even point. So the company needs to sell 7,000 units in order to cover all its costs and reach the break-even points. Alternative method, again, fixed cost plus target profit contribution to sales ratios, 45,000 fixed cost plus target profit will be $18,000 divided by 75% is equal to 84,000 units. So units sold at target profit is equal to $84,000 divided by $12, which is equal to, again, same as formula for one method first, which is 7,000 units. So again, here is 7,000 units. Next will be a margin of safety. Margin of safety is a measure of amount by which the sale may decrease before a company suffers a loss. This can be expressed as a number of units or a percentage of sales. Any questions so far? Or anybody have any issue with voice or screen? If anybody is there, okay. So margin of safety is a measure of how much sales can decline before a company starts experiencing losses. It tells us the cushion a business has against unexpected changes or decreases in sales. So to calculate here, the margin of safety is equal to budget sale minus break-even sales level. So margin of safety is equal to budget sales level, breakdown sales level, divided by budget sales level, multiplied by 100%. Again, the total cost of revenue, total cost sales, how many units, margin safety, this shows profit here. But here is example of break-even sale level is at unit 5,000 units. The company sets the target profit at $18,000 and the budget sales level at 7,000 units. So required calculate the margin of safety in units and express it as a percentage of the budgeted sale revenue. So margin of safety will be 7,000 units minus 5,000 units, budget sales level 7,000 units minus break sales level 5,000 units is equal to 2,000 units. So margin of safety is equal to margin of safety is equal to 2,000 multiplied by 100 divided by 100 minus margin of safety 7,000 minus 5,000 is equal to 2,000 units multiplied by 100% is equal to 2,000 units. So again divided by 7,000 and multiply by 100%, which will be 28.6%. So the margin of safety indicates that the actual sales can fall by 2,000 units or 28.6% from the budgeted level before losses are incurred. So here changes in components of break-even point example. So different components can affect the break-even point. For example, if the selling price per unit increases from $12 to $13, the minimum sale value volume required to maintain the current profit would be. So selling price per unit $12, variable price per unit $3, fixed cost and current profit will be $18,000. So if the selling price is raised from 12 to 13, as I said, if the selling price per unit increases from 12 to 13, so the minimum sale volume required to maintain the current profit would be. So is the selling price is raised 12 to 13, the minimum volume of sale required to maintain the current profit will be fixed cost plus target profit divided by contribution to sales ratio. So here it says 45,000 pound is a fixed cost here, as you can see, and then current profit is 18,000. Target profit divided by 13 is equal to 300 units. So again, in other hand, if the here it says if the fixed cost fall by $5,000, but the variable cost rise to $4 per unit, the minimum volume of sales required to maintain the current profit will be a fixed cost plus target profit divided by contribution to sale ratios. So $40,000 plus 18,000 divided by 12 minus 4 is equal to 7,250 units. So here, in other hand, it's if the fixed cost decreased by 5,000, but the variable cost per unit rises to $4. So the new break-even point would be under this formula, 40,000 plus 18,000 target profit. So divided by $12 minus $4 is equal to 58. This will be a $58,000, and this will be a $8. So is equal to, this will be a 7,000. If you add both of them, 58 will be a 58, and then minus 4 will be 8. So divide $58,000 divided by 8 will be is equal to 7,250 units. So any questions so far? Okay, that's the quiz here. Next session. So that's it for today. This was our learning outcome 2, and we discussed about some different methods and find different ratios, and also in our next topic, next session will be in our next will be on the next Saturday. So if you want to see any useful resources to enhance understanding the concept of managing financial information, you can go the websites here, tutor2u.net and BICE.co, opentuition.com, ACCA. You can see F5 or F2 subjects, foundation 5 and 2. Then you can check on the SEMA website, bpland.com, draft financial statement by Osborne Books. Also, you can visit AAT, you can visit IFA, Institute of Financial Accountants websites. So any questions or anything else which you want to ask? Okay, thank you very much for your today's session, and hopefully, inshallah, we'll see you by next Saturday at 11 o'clock. So have a good day and good weekend. Thanks very much, and bye for now. So if you have any question, you can drop me an email at yasir@ukversity.co.uk. It's yasir@ukversity.co.uk. Thanks for coming, and bye for now.